All right, this is the villain of our epoch. I think this guy, and I've written articles about him, knew exactly what he was doing and set us on a path of destruction. And he talks about the euthanasia of the rentier, which is a fancy way of saying, let's murder the saver and the investor. Let's drive the yield, drive the interest rate to zero. And has anybody at the conference the last couple of days been talking about the falling interest rate or the collapse in interest rates? Okay, I don't want to dwell on it too much. I know obviously everybody talks about price inflation, but I think this is really the hallmark of our era. So, why does this go on? And, central banks put out so much obfuscation about full employment, price stability, which I talked about earlier today. Orwell would be smiling down from heaven. Price stability means 2% relentless inflation to infinity. They talk about, now at least some of the economists are talking about trying to manage GDP through the money supply. They talk about all this stuff. Why do we really have central banks? Get rid of all that. That's rubbish. The real reason why we have central banks is to enable the government to borrow more so it can spend more and buy more votes than it otherwise could if it had to tax you first before it spent your money. That's why we have central banks. And so it's been a wild success. I put that in quotes. And the problem is, of course, we're now in the hangover phase. We're not in the, let's build the interstate highway system in America and all the wonderful things. We're now in the struggling under the debt burden and we can't make it go away phase. So I think a lot of people are on the same idea. We need a path to honest money, and whether you define that as Bitcoin or gold or some combination or whatever, the question that I don't think is asked often enough, how do you get there? And so this presentation is essentially my view on that. I'm going to talk about what we do specifically in the mechanical details, but I thought it would be best to spend most of the presentation really talking about why this matters, rather than the mechanics of you give us the gold and here's what we do and here's the interest rate and so forth. Why are we doing this? So I'm sure everybody's familiar with Warren Buffett here. This is one of those statements that I think is both true and disingenuous. Because of course he's shilling for I guess the Australian term would be spruiking for the Fed and the regime. And he's saying, well, look, gold has these problems. And so he's very dismissive of it, almost contemptuous. The opposite of his father, who was a gold standard man and who was a senator, Howard Buffett, but that's another story. So in the Warren Buffett world, you buy gold and it's basically a bet on the price. Everybody wants it to go up and sometimes it goes down and then you sell it and take your losses and move on. And there's, of course, storage cost. We're trying to change that, and so I offer this as a working definition of the gold standard. If anybody has the right and the ability to deposit and earn interest, that's the gold standard. Anybody can debate me on that or write an article on the internet and name me for that or whatever, but I think that is the essence of it. And I'll go farther and say interest is the only thing that can pull gold into the market. And so I'll use two examples, one the United States and the other China. The United States, FDR makes gold illegal in 1933. They did not go door to door with guns. They just simply made it illegal. I believe in Mao's China they did. And kill you if you hid the gold from the government, or maybe even kill you if you had too much and they took it from you anyway. You don't really get all that much gold that way. People just hide it, they just bury it. And then the more the government is searching for it, the deeper they bury it. So they start maybe a meter down, but if they think the government's really serious, they put it down 3 meters. So I have this picture of this plumbing device. And when I started talking about this stuff years ago, this is a very abstract, abstruse, arcane idea that, okay, how is gold going to flow and circulate? And you have this valve, you basically shut-off valve, and when the valve handle is perpendicular to the pipe, you don't get any flow. When it's parallel to the pipe, the water flows through. We've now proven this. So we have a gold yield marketplace. That's what my company does. And we can see that with interest and with each deal that we announce, gold comes in and it's proportional to the interest rate. So some deals are lower interest rates because they're less risky. Other deals have higher interest rates. And the ferocity of the flow that wants to come in does have a proportionality to the interest rate. So we have deals that range between 2% and 4.5%. The 4.5% are notably more ferocious in terms of the gold. There's a quote from JP Morgan, which I saw once, remembered it, and unfortunately I didn't take a note of it. And every once in a while I Google for it and I haven't found it again. And that is somebody came up to him, this was one of the banking panics in New York. It could have been 1897, it could have been 1907. So Mr. Morgan, there's a crisis in New York, there's a shortage of gold. What are we going to do? And he said, raise the interest rate. 4%, he said, will draw it off the continent. Now think about that. In those days, that was like a steamship, which was expensive and slow and risky. 5%, he said, will pull it down off the moon. Pure, obviously in those days, fantasy. But he was referencing something that I think anybody certainly in the financial markets in those days would have understood. If the interest rate's too low, then the gold kind of leaves the market, and if you raise the interest rate, you'll pull it in. There's no such thing as a shortage of gold. There's only a shortage of gold in the market, and that's a function of interest rate. So what Monetary Metals does is we observe that on the one hand, there are a lot of investors that own gold, and they're not getting anything on it. In fact, it's costing them something. And on the other hand, there are businesses that need gold inventory. You walk into any coin shop in the world, and there's a certain amount of, whether it's gold kangaroos or gold eagles or gold maples or bars, sitting on the counter, that they've got to finance that somehow. And if they finance that by borrowing dollars, you have this problem. You borrow $1 million, let's say, which isn't that much in terms of gold, right? And then you buy $1 million worth of gold. If the price of gold were to fall 10%, you still owe $1 million, but you only have $900,000 in gold. So you could be bankrupt. So then they have to hedge. And so hedging involves selling futures short or something like that. And then it ends up becoming complicated, and there's a lot of moving parts. And with the moving parts, it's both cost and risk. And the whole thing ends up being complicated and expensive. And we come along and say, look, there's a lot of investors over here that have gold that want to get a yield on it. There's a company over here that needs gold in inventory. This is a pretty straightforward arrangement. This company is happy and willing to pay some interest. These people want to get some interest. Let's put them together with the right controls and monitoring and other things that it's not just give your gold and pray that you get it back in a year. And so we think that's just a nice win-win deal, and the interest is paid in gold. So if you put in 100 ounces, and if the interest rate is 3%, that means at the end of the year, you get back 103 ounces. Very simple. No presentation like this would be complete without this slide. And I don't like reading slides, but I think that first item bears emphasis. There's no such thing as a return without risk. Anybody who tells you there is may be committing securities fraud and certainly is misleading you. So what we do is we investigate the thing extensively. We put together a slide deck that puts together the full details, including the mechanics and the risks and all the other things. Each investor decides, do I like it or not? And if I do like it, how much gold do I want to put into it? And what's my minimum interest rate? So each investor might say, look, as long as I get 4% or higher, I'm in. Another investor might say 2% or higher. And then the market sets the interest rate. We believe this is the first time a free market has set the interest rate since the Federal Reserve was created in 1913. Because as soon as the Fed was created, it began to manipulate interest rates downwards. We have insurance. We're not allowed to say in public who it is, but it is a major London-based carrier. That's another layer of it. So the lessee has to have insurance for the gold. We have another layer of insurance that if somehow their insurance doesn't pay, for instance, if the owner were to abscond and go to a non-extradition country or something like that, that would cover Monetary Metals and the investors. This is probably the most interesting graph we've put together in the last year or so. And so what this is showing three portfolios. One of them is the standard 60/40 equities, this is US equities, US bonds portfolio since 1970. Here's the returns you get. Then what a lot of people have done over the decades is said, what if you put a little slug of 4% gold into the portfolio? What does that do? And what you get is slightly enhanced returns. You can see, I think I have a little laser thing here. The gray line is the raw portfolio, and the dark orange or almost red line above it is with a little bit of gold in it. I'm not sure that's enough to really write home about. It is an improvement. More importantly, I think it gives you lower volatility, smaller drawdowns, better Sharpe ratio if you care about such things. Then what we did is we replicated this research and we added this gold line. What if the gold was earning 3.5% interest? The whole thing runs, there's only 4% gold in the portfolio. So the portfolio with 96% conventional paper investments and only a tiny little piece of 4% gold in there, and that 4% of gold is earning 3.5% per annum, reinvested. And you end up with significantly enhanced returns. So here's a chart of what this does in terms of volatility and some of the other metrics. If anybody's interested, you can email me and I can send you this. But all the metrics get better with the yield on the gold. I've got 2 minutes left if anybody has any questions. Otherwise, I think I'm going to be on a panel with some open season on other questions generally. Minimum investment is 10 ounces of gold or 750 ounces of silver. So whether you call that small, it's not for giant institutions, certainly. Yes, sir.
Here, hold on, I'm coming with the microphone.
Wait, hold on.
Thank you. Question about the logistics of gold. Say that if we want to invest 10 ounces of gold into your fund, how is that organized logistically, physically?
So we have depository partners around the world. Here in Sydney, we have a partner with ABC, so you could bring the gold to ABC. Anybody else? Yes, sir. So the question is, do most people compound it? So we're at the stage, we're a relatively early stage company. We're at the stage where the investors are interested in compounding it. I think we'll get to the point where retirees on fixed income are actually going to want to pull the interest out every month with an ACH in the US or FPOS here. Right now, yeah, they do tend to just compound it. All right.
Wonderful. Thanks, Keith. Thanks, Josh.